Good to see everyone. It's been I think it's been 2 months. I was in New Zealand in January, so there's no webinar in January, and in December I don't know if we did one in December. So it's been a while since I've seen many of you. I just realized how zoomed in I am on this new camera. Anyways, let's get going. Trump. I am super excited that Trump has been reelected. We're not going to get too much into politics today, but obviously the primary thing that everyone wants to talk about is the tariffs. Canada and the U.S. are starting to butt heads a little bit now. Obviously, this is a big concern and big issue for all of us, and we're all wondering, what exactly does this mean for us in Canada? What does it mean for interest rates? What does it mean for real estate, et cetera? So I'm going to do my best to give you what I know. By the way, I was at a mortgage conference last week in Whistler, and the chief economist for TD was there. We all asked her, what does this mean? And she doesn't know the answer. Nobody really knows the true answer. So we're going to go through what impacts you can expect, and then what some of the different outcomes are. And we're actually going to be noticing that there's quite a divergence in expectations and what people are thinking, including the banks, et cetera. So first of all, we need to talk about, how much we're aligned and how connected we are. Canada is the second largest trading partner to the U.S., very, very tight behind Mexico. So this is going to have a very big impact on us and the United States, of course. And when we look at, which industries are going to be impacted the most by tariffs, it is primarily the oil and gas in Canada. If you look at which ones would be exposed the most by share of the GDP and the impact, the next one would be primarily the heavy metal manufacturing, things like steel, aluminum, etc. Which that Trump, I think yesterday or today, I can't remember now, announced that he's planning on rolling out that tariff worldwide, not just to Canada. So there's a number of different impacts we're going to see, but there's certain industries, of course, where it's going to impact some people more than others. So, we need to look at how a tariff will actually flow through the Canadian economy. This is a really nice chart that RBC put together. There's the first phase of the uncertainty shock. We've kind of gone through that now. The second phase that we're in at the moment is actually front loading of inventory. So if you expect that there's going to be a tariff, a lot of people are going to front load inventory and stockpile a lot of inventory, and then we're just getting into now the price rise and demand dropping. And so this is the primary concern or primary issue, of course, is the demand dropping for goods and services. And this is really once the tariff has been applied. The next part, we've actually started to see this too, is of course some retaliatory measures. Canada is trying to fight back as best as they can and say, well, we're going to charge tariffs on you, and we're starting to see a little bit of that banter back and forth. And the next phase after that would be the secondary industries and services would experience some knock-on effects. So what we mean by that is that, let's say that there's services that provide or companies that provide services to oil and gas companies, to steel exporters, to potash companies, et cetera. Those companies are now going to start to feel the spin-off effect of less demand for their product. And then there'd likely be a Bank of Canada response, and we'll talk about some of those responses that may happen. And ideally, fiscal policy would be attempting to support that. And there's a number of different ways that things could occur. Obviously, what we'll be talking a lot about today is going to be the Bank of Canada's response and what that could look like. But long story short, if the tariffs do come into play, we're going to see a lot of impacts and a lot of different things that will affect many of us that are watching this, and obviously it's going to have an impact on real estate in different ways. One of the things that I learned and understand a little bit better now is how the tariffs would apply. And really, at the end of the day, what is happening is on a tariff, most products have many different components to it. So when you're selling a car, for instance, there's a number of different products that are compiled to build a car and to sell a car. And one of the things that would likely happen is all of the items along the chain would likely be compacted as far as the margin is concerned. And that means that effectively, if this car is being sold down to the U.S. it's unlikely that the impact would be a full 25% increase to the cost for a purchaser. It's more likely that the consumers would see about 5 to 10% of that cost get passed on to them. The reason for that is that a number of the items across the supply chain would just start to tighten up their margin. It of course would reduce profitability for all of those different industries. Rates will, who knows? We're going to be talking about that in a little bit. Number of different things to look at with regards to rates, but in general, rates would decrease in a situation like this, but not necessarily. There could be government support. And by the way, this is one of the reasons that rates may not decrease. Let's say the government decides to not lower interest rates in order to support the Canadian economy, but instead will provide some government support on specific things. So, as an example, in Canada, we actually provide price floors for things like dairy. So, dairy farmers know they can sell their cheese at certain price points. That's why a lot of people that live in Vancouver will drive just down to Bellingham across the border, buy a whole bunch of dairy products, and then drive back. And you bought everything in the U.S., so it's much cheaper to do so. We might see other types of government support like that. So maybe they provide some incentives to the industries that are hurt the most with this. Canada is very sensitive to interest rates, which is a concern, of course. Moving rates up or down does have a large impact. Canadians in general are quite indebted, in particular because our housing is so expensive and a lot of us borrow money to purchase homes. And so when you look at all of these factors, the reality is that the tariffs are inflationary, and so we may see inflation rise, and it may be soon. However, it's unlikely to be right away. Some of the Bank of Canada verbiage that has come out recently in the last week or two has kind of alluded to the fact that they didn't want to use the word transitory, which is what they used last time in COVID times regarding the inflation. They were smart to dodge that particular language this go around. However, at the end of the day, there's no doubt that inflation is likely to rise with this. If cost of goods is going up, then that means that there's inflation. So that is a general concern, and this is of course why there's that one of those big question marks about what's going to happen with rates. It's hard to say because this whole issue is inflationary, and of course the Bank of Canada has risen rates recently to combat inflation. The other thing too that's important to understand is that unemployment will rise, and so the real tough part for the Bank of Canada is going to be they can't fight a low growth and high inflation at the same time, and that's going to be the real challenge here is coming through this. If we're in a position where unemployment is rising, but inflation is also rising, there is no obvious monetary policy from the Bank of Canada here, other than perhaps trying to provide government support specifically to the industries that are feeling the unemployment the most. It's too bad because we were doing so good on the inflation. Inflation rates were dropping quite a bit in Canada in particular. Obviously, the U.S. is a different story, which is something that I'll be getting to in a little bit too. But Canada was doing so good on the inflation side, and so this tariff issue might be long term, anyways, an inflationary problem. But note that most of the economists don't expect that tariffs come into play and immediately you have inflation. It is likely going to take some time, and that time period, it really depends on who you talk to, but I've heard anywhere from 6 months to 18 or even 24 months before the inflation effects are really felt due to the tariffs. On the unemployment side of things, in Canada, you can see that unemployment has steadily been rising really since, it looks like mid-2022 is when we started to see unemployment start to take off. And that is one of the Bank of Canada's concerns, of course, is watching that. The concern or issue is that a lot of people are losing jobs, then that will not be good. So what does this do for interest rates? This is what most of you are probably here to hear about and learn about. The question is, will rates go up or go down? Funny story, I've had this will rates go up or go down chart for quite some time. And every time I get to say, hey, good news, probably going down. This go around, seems like it might still be interest rates going down, with a lot of asterisks this go around. So first, I want to show you this chart. This is the 5-year bond yield. The reason I'm showing you this is that this is how fixed rates are correlated. Money gets bundled up and then sold, and sold to investors. These are generally international investors buying bundles of mortgages. They can buy Canadian bond yields. They can buy mortgage-backed securities, other similar asset classes. And so if you see the bonds going up, that usually means that fixed rates are going up. If you see bonds going down, usually fixed rates are going down. So of course, you can see on this chart, recently, 2024 and into 2025, in general, you've seen that those bond yields have been going down. However, I want to point out a little bit of an important item here, that right around here, you can see the blue line, that's actually been going up. And I think we all know who and why the interest rates have been going up and the yields have been going up in the US. Now, the reason this is relevant is Canada has been quite weak, and a lot of our unemployment and whatnot is pointing to us probably needing a lower interest rate. On the flip side, the issue is that in the US, it's a different story. And what happens is if the US bonds are well supported and are going up, which they've gone up about 0.8%, by the way, in the last 3 months, it does create a bit of a floor and buoys the Canadian bond yields. And so over the last few months, even though we expect that interest rates should be dropping, we're actually finding that the interest rates haven't really been moving much on the fixed rate side of things. And so it'll be interesting to see what happens moving forward, but we are intertwined in many different ways. And this is one of those areas that we are fairly intertwined. I do want to also point out what happened when the tariffs were announced last week. This is one of the biggest drops that we've seen in a single day of trading that we've seen in a really long time. And you can see that immediately, the same day, they actually skyrocketed back up and basically started or finished the day where they started, which is really interesting. That, of course, was because there was an announcement later in the day that, oh, Mexico and then Canada, okay, you guys get 30 days to figure things out. But every day it seems like there's back and forth on this, and we've seen some pretty big swings in the bond market because of this uncertainty that we're seeing. And so with that uncertainty, it makes it really difficult to make predictions. When you ask a number of different economists, everybody has a different opinion about this. And this is where things get really tricky to be able to provide advice and feedback to customers on what should you do. Should you be taking a fixed rate? Should you be taking a variable rate, etc.? So I'm going to go over this next chart with you. This is probably one of the easiest ways to understand where the banks are all expecting the prime rate to go. Okay, so obviously we have the current rate policy. Now, just to give everybody some perspective, that's what's called the overnight lending rate. That rate is 2.2% lower than the prime rate. So the prime rate right now is 5.2. That means that you deduct 2.2% or 2.2% off of that, and that's what these rates here are. So basically what we're looking at is that the policy rate for Q1 of 2025, so this is really now because we've already had the January meeting where we did see a 1/4 point decrease. This is really suggesting what are they going to see for the next meeting, which is on March 12th. And I can tell you that looking at this chart, it's fairly obvious. Half of them say there will be no change. Half of them say there will be a change. Now, there's another index that I follow. It's basically people that professionally bet on what the Bank of Canada is going to do, basically day traders. And they are pricing in about this morning it was a 62% chance of a cut on the March 12th meeting. So that means that a slightly better than half of a chance Bank of Canada will cut a 1/4 point in March. Then from there, you'll see that many of the banks are doing one more cut sometime in Q2. So if you didn't do a cut, then there would be one cut in Q2. If you already did one cut, then you're still doing one more cut. In fact, RBC thinks there'll be 2 cuts in Q2. And then Q3, again, you're finding that a lot of them are starting to get down to either a 2.5 or 2.25. So we're looking at 2 to 3 cuts by Q3. And then by the end of the year, again, seems like it's staying around that. So long story short, if a lot of them are saying 2.5, 2.25, 2.25, 2, Scotiabank looks like they're the only ones really that are predicting that there won't be any change during the year. And then TD thinks it's 2.25. It really is a situation here where they're expecting that perhaps the rates do go down by 0.5 to 0.75%. And this is relatively in line with what I've been hearing as well, which is that most of the banks were expecting this year to maybe see about 0.5% more in cuts. And now with the whole tariff situation, it's between 0.5 and 0.75 cut is the current expectation. Interestingly, too, if you look at the 2020 end of the year 2026, a lot of the lenders think the rates will be exactly the same. The ones that do predict this, anyways. Except for National Bank is actually thinking that maybe the rates bump up, and my expectation on that is that National might be thinking, well, if inflation is a factor, then maybe the rates will start to tick back up again to try to combat that. Now, I do want to point out something here. So BMO's expectations for 2.5% for Q4 2025 had an asterisk next to it. The asterisk was suggesting that this is assuming that there are no tariffs. The rate that they think that the Bank of Canada would go to if there are tariffs is 1.5%. That is an extreme decrease in interest rates. So they're expecting, if the tariffs do come and they stay during the year, that we wouldn't be dropping 0.5%. We'd be dropping 1.5%. That would be effectively putting down the prime rate down to 3.7% from 5.2 where we're at today. A massive decrease. We didn't get predictions from anybody else, but I know that RBC has already kind of caked in a full 1%, regardless of the way that this plays out, or perhaps they're just making the judgment call that the tariffs will come in and will stay. So long story short, it does look like the Bank of Canada, anyways, may see some drops. So what we're finding right now is on the fixed rate side of things, we looked and saw that bond chart. I didn't show you the bond chart for every single term, by the way. I just showed you the 5-year. Most of the time, we're looking at the 5-year. What we're finding immediately in the market right now is that just in the last 2 weeks, we've seen a lot of the short-term fixed rates, like the 1 years and the 2 years, have come down quite substantially. And that's because the 1 year and the 2 year fixed rates are much more correlated with what they think the Bank of Canada is going to do and where the Bank of Canada is going to be in the next 12 to 24 months. And so it seems like the short-term money, 1 and 2 year money, is dropping quite a bit. And that's because it's starting to price in the fact that they do think that rates will be dropping and dropping a little bit more aggressively short-term. At the same time, the 3 year has been about the same, and the 4 year about the same, and the 5 year with many banks has actually ticked up a little bit, which is very interesting. And so what that's suggesting is that because of the tariff situation, I think that many economists and other traders are expecting that maybe the rates go down short term, but then maybe come back up in years 3, 4, and 5, perhaps. And so I'm seeing some clients get quotes where the 5 year mortgage is almost 0.25% higher than the 3 year fixed, which is not what we've been seeing prior to the last 2 weeks. Prior to that, so the 3 and the 5 were pretty similar. So pretty interesting to see how this all plays out. Usually 5 year rates are cheaper than shorter term rates in most cases. Usually just because a 5 year term is more profitable for the bank because you'll be a customer of theirs for longer. And there's acquisition fees regardless of how you get that mortgage. But it'll be interesting to see what plays out here in the next 3 to 5 years. On the Bank of Canada side, this is the trickier one. So looking at what the Bank of Canada is going to do in this same time period, it seems like everybody's saying, almost certainly, pretty much everybody except for Scotiabank says, we're going to go down another 0.5% in the next 3 to 6 months. And so when I'm talking and having a conversation with the customer, it's looking at, hey, if the rate goes down about 0.5% in the next few months, then what happens after that? And that's where the economists really split. And because if the tariffs are in or they're not in, but most economists, regardless of the tariff situation, have been expecting about 0.5% decrease to the prime rate. And so usually when you're trying to figure out, should you be in a variable rate, I'm usually starting to estimate that and looking at what would your payments and your interest costs be if the variable rate doesn't decrease at all, of course, but also looking at, well, what if it goes down about 0.5%? This seems like a reasonable expectation because almost everybody is expecting that to happen at least. And then after that, it's, well, that could be it, or we could see another 1% drop or no more further drops at that point. So if we look at what's happening in the trend with fixed versus variable, this chart is showing you the difference between fixed rates and variable rate pricing. You're going to see at the very end of the chart here that they're just now starting to get right around the same interest rate. So finally, variable for quite some time, the last couple of years, has been elevated and has been more expensive than fixed rates, and that is finally starting to settle down. We're finally starting to see that you're not going to start off in a variable rate at a significant premium anymore. It was that for quite some time, we're having customers look at that and think, well, if I take the variable, I'm going to be at a much higher interest rate for an extended period of time. And do you want to take that variable rate not knowing if the rates will go down as much as being predicted? And it does seem like now, at least, we're very, very close to that. And we'll get into what we're seeing for rates and talk about that in a minute. But at least we're starting to see that tighten up. Actually, one other point that I wanted to make on the one of the previous slides too is the reason that the Bank of Canada may cut as much as they're potentially getting priced in based on the economists is that if the tariffs do come in, one of the tools that Bank of Canada has is to lower our interest rates in Canada. So to lower the Bank of Canada rate, which, by the way, does not mean that the bond market will decrease. It's a very common misconception. Every time the Bank of Canada drops 0.25%, I get at least 10 emails saying, hey, I saw that the Bank of Canada went down. Do I get a better fixed rate? And the answer is no, unless the bond market also decreased. So it's a different metric that you need to be following. And we've seen for quite some time, the last few months, that Bank of Canada keeps coming down and the bond market has not really been moving much. However, if the Bank of Canada lowers interest rates here in Canada, what ends up happening is it actually will devalue our dollar. And if we devalue our dollar, it puts our goods on sale. And so if we're in a situation where the tariffs are adding an extra 25% to pricing, well, we can at least mitigate some of that increase of the cost by artificially lowering our dollar. And we actually had that happen in 2015 because oil and gas was doing quite poorly. And the Bank of Canada lowered, I believe it was 0.75% that year, and even though the US didn't move at all. And it was in order to put some downward pressure in the dollar, which made our goods cheaper to purchase in order to make sure that we are still able to run a full economy with full employment. On the flip side, this is the other thing to consider is that if we're looking at an insured or an uninsured variable discount, they've definitely been decreasing. So this chart, by the way, I got it from a website that tracks, I think it's like the absolute lowest rate in the marketplace. And looking at those spreads, you're seeing that they've been obviously decreasing. The trend is not in the right direction. What often happens is that the situations that cause the Bank of Canada to cut interest rates often will actually create some upward pressure on the discount. And so instead of getting a discount of prime minus 1, you might be only looking at prime minus 0.5 or something like that. And so we're actually finding that right now, that is what we're seeing. Even just a few weeks ago, a lot of our customers could get prime minus 0.7 pretty easily. Now, a lot of the same banks are now prime minus 0.5. Doesn't mean that that's the best rate, by the way, but we're finding that like a standard mortgage, most of them are around prime minus 0.5%. And then typically on a 3-year fix, most standard interest rates are around 4.44. So that's kind of the general expectation that you could be looking at the moment for owner-occupied mortgages. Generally, by the way, rentals are usually priced at a higher interest rate. But when we're looking at this, you're noticing that the variable rate is only about 0.25% higher than the fixed. And so if the Bank of Canada cuts in March, you'd be about the same rate with likely, or more likely anyways, some room to be lower as opposed to going higher. But obviously the decision of going variable or fixed is a very personal one. Even if we look at the chart, I just ran the analysis again for a $750,000 mortgage starting March 1st, and the projection based on the current expectations is that this borrower would save about 16 grand over the next 3 years. It went variable instead of fixed, which is quite significant. So it is something that obviously you have to think about, okay, but what if the rates go up? And that can happen. You can't be going into a variable rate thinking, well, no, whatever what happens, I'm going to be fine because the variable rates are going to go down and I'll be okay. There are different types of variable rate mortgages, by the way. Some of them have a fixed payment. Some of them have a payment that moves with the prime rate. If there's any risk or concern about maybe the interest rates going up, then maybe a product where the rate is the payments are static, it would be better. But also a lot of our customers in the last at least 6 or 12 months, most of them are opting for the variable, whereas the rate goes down, the payments go down. So you actually get some payment relief because obviously rates have been elevated for quite some time. I do want to talk a little bit about the impact on the real estate market too. So of course, we talked about what would happen to interest rates. And long story short, it looks like the fixed rates, probably not a whole lot of movement, relatively flat, except for in the shorter terms. I'm seeing the ones in the 2 years dropping a little bit, getting closer to where the 3-year and the 4-year and 5-year rates are. And then if you're looking at the variable rates, to sum it up, you're looking at probably a 0.5% decrease to the variable rates in the short term. And then who knows, it could be another 1%, depending on how this whole tariff situation all plays out. Potentially, however, that if it does drop very aggressively, we might see a bit of a rebound once the inflation starts to set into the marketplace, which is what I'm hearing some economists kind of talk about. Bank of Canada might cut aggressively and then might start to have to come back up, depending on how this all plays out. So what does that mean for real estate? This is something that I've been watching quite a bit, and it's the new housing starts. This is something that obviously, there is a lot of new housing starts starting in mid 2020 into 2021. There's a massive drop off, of course, because of COVID, and then a significant increase because of all the demand for housing. But the primary concern that I wanted to kind of point out here is the trend in the last 4 or 5 months has been that there's been a large cut here. We're finding that especially in some of the major urban centers like Toronto right now, condos are really feeling it. It's pre-sale condos are not in a great place right now. And that is definitely a concern. And this is something that's really important to watch, because if the housing starts to decrease, this is not good for the housing supply. And the most important thing is this chart. And so if we look at the annual population growth compared to the number of residential units being constructed, look at the amount of people that have been coming here and immigrating to Canada over the last couple of years versus the number of houses that have been built. Now, we've always had this gap. Going back to this chart, goes back to the 50s, actually. It seems like we've always had a bit of a gap here with population growth versus the number of housing starts. But for the last 10 years, it's been a lot closer. And now we're finding that in the last 2 or 3 years, it's just completely ballooned, and to a certain extent is kind of out of control. This is going to be a major issue, and this is one of the reasons that we saw rents increase significantly the last little bit. It does seem, by the way, that rents are starting to settle. They kind of spiked and they were very high, and now they've come down. I'm hearing a few percent in most areas of Canada. But the major concern, of course, is you can't have over 1 million people move here to Canada and not build enough homes for them. It's just not significant enough, and that will be a major issue. Now, I also wanted to share some information and insight that I've kind of learned about what it's like to build properties in Vancouver. So let's say that you're a big developer and wanting to build a high-rise in Vancouver. Front to back is about 8 years to build a high-rise in Vancouver. And one of the reasons that timeline is really important is that it just often doesn't make sense. It takes you that long to get the permitting and to go through the rezoning process if needed, and then to do construction, that timeline is really expensive. As an investor, one of the things you're looking at is return on investment. But one of the key factors is not just the return on investment, but the return on investment over what time period. If I give you $100,000 and you say that you're going to give me $150,000 back, I'd say, well, that's great, but how long is it going to take for you to give me that money back? If it takes you 10 years to give me the money back, well, that's not a great return. If it takes you 1 year to give me that money back, that's a 50% return. That's awesome. So this is one of the issues, of course, is if it takes 8 years, it takes you a lot more time to get your money back. And the other issue that we're seeing is that in order to be profitable, these buildings have to sell at about $2,500 a square foot. I mean, these are crazy numbers. It's just way too expensive. This means like 500 square foot condo would have to sell for 1.25 million. It's just not realistic. And so one of the things that they've looked at is that even if the land was free, it still wouldn't be profitable to build. And so we're finding that a lot of the builders are in this position where interest rates are too high, the demand is too low. It's just not a great time, and that we're likely going to be in a situation where we're going to have a housing shortage in the next little while. In fact, CMHC in their last fall outlook was predicting that exact thing, and when they were looking at where housing is going to be in the next couple of years, it seemed to be anywhere from 7 to 14% higher by the end of 2026 for the values, which I thought was a bit high, especially for CMHC to be predicting that. So regarding real estate values, you have a couple of factors that would be a plus for anybody that owns real estate or is buying real estate today and hoping that they'd see some appreciation, which is that rates may fall. If the Bank of Canada does cut and it cuts aggressively, lowering interest rates almost always in a vacuum will have a upward effect on values because somebody can afford more. Secondly, another reason that we may see house rate prices go up is that we may see a less supply than demand for housing. And so if there's more people trying to shop for less homes, we may see that we'll be in a situation where values will increase due to that. On the other side of the coin, increasing unemployment is the primary risk that we need to think about here with regards to the tariff situation. If employment starts to increase, then you may see that more homes may get listed. And I don't have this on the list here, but there is some lingering effect of interest rates being so high for so long too, that there may still be some other people that may be holding on and trying to make things work, but at interest rates at elevated levels may decide that it just isn't feasible and they have to sell themselves. So overall, there's a number of different things to look at. We do have some ways to make it easier for you to understand if buying real estate makes sense, and also if you qualify. I've taken what used to be a spreadsheet and then made it into a fancy spreadsheet, and then eventually turned it into software. And we've developed something called Atlas, but it allows us to punch in your information in a very quick calculator, and it underwrites for all of the lenders for all the programs simultaneously. So it makes it a lot easier for us to assess whether you qualify or not before you go in and jump into a full application. So if you do want to learn more about that, feel free to book a consultation with us. Also, if you don't already have a book of mine, I think many of you that are on here do have a copy of my book, Rockstar Real Estate Investing. But if you do not, please email us at info@greenmortgageteam.ca. I'll be happy to put a copy in the mail. Please send us your mailing address if you'd like us to send a copy in the mail. So that's all the information I have for the presentation. I'm happy to answer any questions. If you guys want to put some questions in the Q&A, I'm happy to answer that. And if there's any other questions, if you can't put it in the Q&A, then you can put it in the chat as well. So far, no questions. You guys are taking it easy on me today. I thought there'd be tons of questions about the tariff situation, and I'm not going to be able to answer all of them, by the way, but I figured people would have more questions. I'd be surprised if I gave everybody crystal clarity on exactly what's happening with the tariff situation. All right, a couple of questions are coming in. So if there is high population and low supply, then why are rents falling? Good question, Terrence. So my thought on that is that what happened is a lot of the immigration all happened. It all happened mostly in 2022 and 2023, which is why we saw a lot of the rent appreciation. I think that then once things settled, and with don't forget that Airbnb was banned, and I think that you had a very short-term blip of new supply entering the marketplace. So I think that's probably why we saw that the rents have decreased a little bit, because most of the immigrants that have moved here in the last few years did so in 2022 and 2023. So we had a lot of increases there. I think that they started to curb the inflation a little bit, so less new people moving today. And then also, I think that the release of a number of units that were used for Airbnb all of a sudden would have decreased the available supply. I've got a question in the Q&A. Hey, Keith. So what do you see for home prices in Vancouver, single-family dwellings? Generally speaking, what I would expect for single-family dwellings is that the prices are likely to start to rise, and I don't know when that will be. It could take 3 or 6 months, but I do expect that by the end of the year, I think that single-family dwellings will be higher. On the condo side, I'm a little less certain exactly what's going to happen to condos. There are a lot of pre-sale condos that I'm experiencing that the purchasers, who are primarily investors, bought those in 2021, 2022, et cetera. I don't really want them anymore. So it'd be interesting to see what happens there. I'm more certain that that single-family home prices will be higher, less certain that the condo prices will be higher. And keep in mind too, there's also the zoning sweep that is getting thrown over, allowing people to build up to 6 or even 8 units. I think that that's also going to benefit mostly single-family dwellings and detached. Sandra has a question. Is it better to hold on to my investment property for the 1 or 2 years or longer? I have a 2-bedroom condo. In most cases, what I'm advising to most of our clients is if you're hanging on and you're trying to hold on to your property, I would generally say, if you can, I would hold on to it for 1 or 2 years, or of course longer. But I think that you'll likely you'll probably do better on your investment if you hang on to it for 1 or 2 years. Did the policy change in Airbnb impact rent too? I believe so. So I have a couple of friends that are property managers, and they felt that, especially in major urban centers, there was a lot more inventory available right after the whole Airbnb thing happened. So I think that that's a large factor on the rent pricing. Cam asks, do you see do you seem a bit split in terms of trends between multifamilies and single-family real estate in Vancouver and Victoria? It's an interesting time. A lot of the multifamily just doesn't really seem to be moving that quickly. I think it's really hard to price out the multifamily deals right now. I think that the challenge with multifamily is that the BC government is very pro-tenant, and it makes it very difficult to make the deal worthwhile to do. As an example, when you buy a multifamily property in Vancouver, you're probably having to put 70% down approximately in order to make that deal work. You can do it in Victoria with perhaps 60% down or something like that. But long story short, you're often having to put a significant down payment down. Maybe Victoria's 50%, by the way, but regardless, you have to put a significant down payment down to make those deals work. I'm actually finding a lot more of our clients are looking at still industrial. Industrial had a crazy run up during COVID, and then it kind of relaxed a little bit. And I'm still seeing more people buying in the industrial side of things. I think that the key is if you can get CMHC insured multifamily financing, that is where the money is. And unfortunately, in YVR and Victoria, like in the core hubs, it is still very difficult to get the amount of financing you need. But if you go to Mission, Chilliwack, Abbotsford, or if you're looking in on the island, you're going out to a smaller community. If you're going to Duncan or Souk, or not really a lot of multifamily in Souk, but if you're going to Duncan or something like that, maybe in Nanaimo, I think that the deals seem to pencil out a little bit better there. I've got a question here. I've been trying to rent out a 1-bedroom condo for months, and the rental market is flooded. I've lowered my monthly rent to half of what I was charging prior to the short-term rental policies, and still barely any inquiries coming in. There's over 30 rentals in my building alone on Craigslist for this month. I mentioned other buildings having other issues. I don't see any shortage in housing. In fact, this tells me we have an oversupply. Yeah, so I do think that what we're finding right now is that on the rental market specifically, I think there's a short-term oversupply, and I'm not sure how long that will last for. But I do think it's primarily the short-term rental ban. I'm interested to know too if perhaps your building's one of the buildings that allowed short-term rentals to exist. That might be one of the reasons that that we saw such a tick up in your building in particular. Keith is asking, are you seeing a trend of investors moving into or out of rental properties? Good question. I would say probably slightly out of rental properties. I probably have more clients that are selling than buying, but it's not a massive difference. Keep in mind too, and this is me trying to be subjective, because technically I only help people really on the buy side, so I'm going to see more of that. If I had to step out and try to take my own work and employment bias out of it, I think that there's probably slightly more of my investors selling than buying, just to kind of rebalance their portfolio. A lot of them are very real estate heavy, but I wouldn't say that that's it's a massive difference. I would say in the last 6 to 12 months, investors are starting to come back. In 2023, it was like dead. Almost none of my investors were buying. Most of them were just buying GICs and hanging on. Selena asks, where would you invest into like which market you're looking at investing in right now? Oh, that's a tricky question. With the tariff situation, it makes it harder to justify buying in a blue collar area that is going to be heavily impacted by the tariff situation. So that is something that I would take into consideration for sure. I do like Vancouver Island. I think as a general concept of like where people are going, aging demographic, a lot of people like to be would like to be on Vancouver Island. I do think that the prices are reasonable, the rental rates are reasonable, and I think there's growth there. So I would be perhaps looking there. I'm still very interested in downtown Vancouver. I'm wondering if and when that market will come back. But I'm finding that people are getting really good deals in downtown Vancouver. And I just wonder if with the COVID situation, people were leaving downtown Vancouver and they haven't really come back as expected. So I kind of expected once COVID was in the rearview mirror, more people would come back to the major urban center because they realize that, oh man, to go to a Canucks game, I've got to take the SkyTrain from Coquitlam, and that's a real pain in the butt, or if I want to do this event or that event. So I'm not sure. I'm wondering if downtown Vancouver will be a good buy. Other than that, it's really comes down to the property. I think that there will be some interesting buys in tertiary markets in the next little bit. So if you're buying in an area where there was a short-term rental ban in a market where there's a lot of people that owned in that area, I think you might be able to pick up a unit at a discount. So I might be looking in those areas too. Joy is asking, can we get access to the recording? Yes. So after the event, we'll be sending out the recordings to all of the attendees. And then if you'd like to just share that with anybody, then you're free to do so as well. Karen asks, if you were getting a mortgage today, would you do long or short term? Most of my clients are going short term, i.e. going variable. I think that in general, I think that because there's a big enough difference there that you can look at a price out, the majority of our clients are going variable. I'd probably say about 70% of our clients are going variable. And then on the fixed rate side of things, it has been mostly 3-year fixed. But very recently, I think that we might see that more clients might start to take the 5. And I've actually had a couple in the last week or two with the tariff situation just say, give me a 5-year, I don't want to think about this. So be interesting to see if that becomes a trend moving forward, especially if all of a sudden the markets are pricing in that long-term money will be more expensive. I'm actually encouraged, even though the rate is now higher, I might encourage more people to think, well, maybe if the banks are thinking that rates will be higher in the next few years, maybe I should be thinking about what happens if rates go up and taking a 5 instead of a 3, especially for insured mortgages or what's called insurable. There's a different classification of mortgages where the 5 years are still usually lower than 3 years. In those cases, I think that we've been seeing more clients take 5. But for uninsurable, so 30-year amortizations for non-first-time home buyers and over 20% down and stuff, that's where we're seeing a bit more in the 3-year. Cam asks, do you see developers buying land assemblies much these days, or pretty quiet? To be honest, that's where I'm seeing a lot of the stress in the marketplace is the land. The people that are hurting the most are the landholders who are trying to hold on. They're calling me saying, "Hey, I just need a couple $100,000 to get through this next little bit," and they're trying to solve a debt problem with the debt, with more debt, and it's just not a great solution. And so those developers often say, "Okay, I'll try to find equity," and it's really tough out there right now to raise equity for land development. So I think that's where the pain is, and I think that's also another reason that I'm suggesting or thinking that a year or 2 or 3 years from now, there won't be enough housing to supply for the number of people that are looking for it, and I think that's what CMHC is kind of expecting too. So I'll go back to some of the chat. Oh, land assemblies are tough to sell as well. Oh yeah, 100%. No, it's a tough one. I 100% agree with that. I have a couple of other things to look at here. Let's see here. Have you heard anything about the TOA specific development process? I'm not sure what that is, Karen. If you want to, if you have more information on that, I don't know about the TOA specific development process. Thanks, Fred. Good to see you. Kevin, thanks, Kyle. Your finger on the pulse of the interest market is most helpful. Good. There's a question here from Herman. Predictions for townhouses. I think they'd be relatively flat to increasing. So my prediction would be detached will be the ones that will do the best in this next 2 years, followed by townhomes, followed by condos. So I think townhomes are better than condos, but probably not as good as houses. Sharon asks, how long do you think the interest rates will keep going lower? Do you see any interest rate may increase in 2 years because of stagflation? Yes, that is what the market is starting to cake into the marketplace. So they do think that, yes, short-term rates will be low, but then in 3, 4, 5 years, the interest rates will start to actually go up. So that is a concern, and that is what the markets are getting, what they're pricing in. I don't know. It's really hard to predict that many years in advance, and I save that for the people that professionally get paid to do that. But that is what people are expecting is, yeah, short-term rates may be low, but longer term will be up. Jenny asks, if you're renewing a mortgage right now, what term did you sign, 3-year, 5-year, or variable? Again, it kind of depends on your circumstances, but and the rates offered, by the way, too. But if you can get a deep discounted variable, I'm inclined to go that direction because we saw that if the tariffs do come into play, rates may decrease significantly, and that would, if they go down 1.5% in the next 12 months, that's going to blow the fixed rate out of the water completely. On the other note, tier 2, if you go variable, you can always lock it into a fixed rate at any time during the term of the mortgage into whatever fixed rates are at that time. So it gives you the ability, if you have to, always just lock it in and convert it. So that does give me some comfort knowing that that's there. And then the third reason is the penalty on the variable is 3 months interest. If you break a fixed rate mortgage, it's 3 months interest or interest rate differential, whichever is greater. That interest rate differential can be 2 to 5 times more expensive than 3 months. And so if rates drop and they drop significantly, you might get caught where if you had to sell the property or break it for whatever reason, your penalty could be significantly more expensive. Kevin asks, I have a $400,000 mortgage on my rental unit as a variable prime minus 0.45. Is it time to fix or wait? I would probably wait. I'd probably ride out the variable at that discount. It's not an amazing variable, but it's pretty close to what you'd get on a new mortgage anyways. I'd probably just ride that one out, Kevin. And you're probably going to see that rate will decrease about 2 times in the next 3-ish months. And if that's the case, then you're going to be getting your rate down to the low 4s. So I'd probably just ride that out. Would you buy a rental property, Indiatown, Toronto? Okay, I think that's in downtown Toronto right now. If I could get an amazing deal, I would look at buying a downtown condo in Toronto, but I'd have to get a really good deal. I still think that there's blood in the streets, and it's not going to go away in 6 or 12 months. but you can perhaps find somebody that's willing to sell it at a huge loss. Like if I could get something 20% under market, or 10% under market, but probably more like 15 or 20% under market in Toronto in a condo, I'd be more inclined to do that. But Toronto is really hurting right now. I wouldn't touch it unless you're able to get a really deep discount on it. Charity. Kevin asked, do you recommend a pre-sale project with a 5-year time frame? It could work. The nice thing about the 5 years is you're not committing to it now, and by the time that it completes, you're probably in a better position. The only thing I'd caution you is, if you're closing on it in 5 years' time, and if the predictions are true, then maybe rates are actually just a touch higher than they are today. The other component to this is that I've experienced a lot of my investor clients who bought pre-sales a few years ago, and now that they're completing, their financial picture's changed, their game plan has changed, and they're trying to sell and get out of the pre-sale and not close on it. And a lot of people don't want to close on them, and they're finding that they can't assign it because the developer is blocking them, or that there's no demand, or there's all these other restrictions. I'm noticing a lot more developer restrictions on being able to assign pre-sales. So hard to say. I think that you may do well on it, but I highly recommend that you go in there prepared to close. I think it's wishful thinking to assume that you'll be able to flip the contract prior to. You definitely be prepared to close on it if you have to. Karenisa says, TOA, transit-oriented area, so within 800 meters of a SkyTrain. Have you heard of the cities making it easier for approvals? Recently, I haven't heard anything from the city making it easier for approvals specifically. In general, that's usually where they want to add density. But I haven't heard anything specifically about that from any of the cities. I don't stay that close to the pulse on what the developers are seeing specifically for that. Thanks, Cam. Sharon, I have a 3-year fixed rate term mortgage, 1.5 years in. Is it a good idea to refinance to take the equity out now and get lower interest rates? So it could be. So that's a good question and good point. We found that a number of clients that took 3-year fixed rates in the second half of 2023 or early 2024 might stand to benefit by breaking the mortgage and redoing it. If your rate is 5.5% or higher, see, Keith, if your rate is 5.5% or higher, you'll probably end up finding that the 3-month interest penalty to break it, you will recoup that penalty after about a year of the mortgage, and then the last 6 months that you have remaining in your current term would all be like bonus. So it depends on the size of the mortgage. If it's a small mortgage, like $400,000, you might find that the benefit is only $2,000 to do it. It's very easy for us to do the calculation, Sharon. So if you want to send me an email with the mortgage amount and all the other terms and whatnot of your rate that you have, whether it's fixed or variable, et cetera, then just feel free to put that in the email, and then I can run the analysis for you. But we have found a number of clients, especially if you're 5.5% to 6% interest rate, most of those clients will save money by refinancing. Awesome. Any other questions? Okay, it looks like we're pretty much done. So thanks so much for coming out. If you have any questions, anything else that's lingering, feel free to email us. If you don't have a copy of my book, make sure you get that. And thanks everyone for coming out. Hope you found it enjoyable and as clear as mud, given the circumstances we're all in. So thanks so much, everyone. Good to see you. Have a good night.